Hey everybody, welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is David McAlvany, who is the CEO of McAlvany Wealth Management. David, thanks very much for coming on the show.
Good to be with you.
Let's start off with your sort of big picture view right now. How do you see things? We've recently started to look like the U.S. economy maybe coming back a little bit, but still growth worries in Europe. China is still a question mark, although there have been some maybe new reports of possibly a turn in their monetary and fiscal policy. How do you see things right now?
Well, I think you start with the debt picture. We've gone through a 30 to 40 year period of credit expansion, and that's something that would like to be perpetuated by the world's central bankers. We like the idea of growth. We don't like the idea of either slowdown or even a correction. So anything that they can do at this point to keep things getting back to normal, that's what they're trying to do. They've tried fiscal options and it's not worked. Austerity was not popular. If you wanted to look at 2011 as sort of the year of experimentation with austerity, they're going to find that 2012 is really the response to that. It's a year of anger. Where
so you think they're going to stop the austerity? I mean, it seems to me like that austerity and that whole mentality as a policy is very entrenched.
It's something that's not popular, and I think what you'll find, we've got 2030, when you look through the G20, you have actually 50% of the leaders changing this year. So we'll get to see just how people vote in terms of those austerity measures. You implement a policy, the question is, can they keep it in place? We would argue that fiscal policy is not going to be the solution. It should be, it could be, but it won't be. The monetary solution is what they've continued to seek. Take the U.S. for instance. We run an official rate of inflation of like 3%. If they can cheat on that number by 2%, that extra 2%, do your time value of money calculation, will take our $70 trillion stock of debt and cut it into $35 trillion over a 16-year period. That's compelling to them. And so there's motive, if you will, for fudging the numbers in terms of the CPI and having us believe that inflation is less than it is. The other benefit, if you will, of understating inflation is that you end up overstating GDP, which certainly helps your advertising and PR campaign. The consumer needs to feel inspired to get out and spend. We have a consumption-oriented society, and our economy is 65–70% based on consumption. If the consumer remains on strike because he's concerned about the economy, because he feels he needs to tighten his belt, then the government has to step in. That, in fact, is what we've seen. So you've got monetary intervention on the one hand, QE1, QE2, Operation Twist, and then you've got intervention, if you will, from the government, deficit spending, between 1 and 1.5 trillion.
But that's coming down. I mean, if you look at projections for this year, 2012, in the United States, Congressional Budget Office is talking about the deficit going below $1 trillion for the first time since 2008. That represents a shrinkage of about $300 billion in the deficit. That's significant. That's like 2% of GDP.
Love to see it. Hope it happens. That would be a step in the right direction, and it would support other issues here in the United States, which are growing positive. Purchasing Managers Index is back above 50. That's helpful. Not so in Europe, not so in China. And I think that's where sort of the interconnectedness of the world, even though things are improving here marginally in the U.S., we've got some significant headwinds in Europe. Maybe we've got a 3-year pass given the fact that the central bank there is willing to spend an unlimited amount of money. December 1st was a real game changer in Europe, just using that word. China then represents a significant issue, and that's something that has a major impact on commodities, because they're 40–50% consumer of most of your industrials.
Now, what about China? Because in the last year and a half, we've seen policy designed to constrain lending, raising of bank reserve requirements, this sort of thing. And we've seen a slowdown in the Chinese economy. We've seen a very pronounced correction in the Chinese stock market. But recently, there's been more talk about maybe a reversal of this policy. Have they engineered the soft landing that they were trying to engineer, or is it still open to question?
I think it is open to question. One of the things that's hard for us to appreciate here in the West is that even though they have embraced certain elements of capitalism, they still are, by and large, a command economy. So command economy with characteristics of capitalism, maybe we're the flip side of that, capitalism with characteristics of a command economy. But that's something where, if the chips were allowed to just sort of fall as they may, we would see a very interesting story unfold in China. It's in the banks. You've got $1 trillion which went into real estate development, infrastructure projects in the last 2 years. You've got 40 billion with a B square feet, which is under development at present. Of course, that's a support to your industrial commodities. The question is, if they don't fill the space, if they slow that pace, then we know the direction of copper, we know the direction of chrome, we know the direction of molybdenum, we know the direction of nickel.
So that's a good segue, given your macro outlook. Let's talk a little bit about those markets. Metals, that's your area of specialty. And let's start with the industrial metals. It sounds like you're not that sanguine on the growth outlook in China. Maybe that's going to pressure some of the industrial metals, at least in the short term?
I would agree. I think that's the direction for 2012, 2013. That's a fairly large picture, but I think we'll have more clarity on that as soon as we get past the Chinese New Year, to know whether or not the Politburo is going to spend another $1 trillion. If we're going to see a repeat of 2009 and money coming into the system, we don't know where that money will be channeled. Will it go into the stock market this time instead of into real estate? That would be an interesting question.
Well, there has been some talk about the Chinese incentivizing money managers to buy stocks.
Right.
Yeah.
Right. But I think the other issue, I mean, in terms of your ags, they take on a different dimension, supply and demand-wise, with supplies sort of being the X factor. When it comes to precious metals...
Well, let's, ags, just to clarify, a more bullish fundamental outlook, you would say?
Yeah, because I think when you look at the commodities, if you want to create sort of a taxonomy for them, you've got what you need, what you want, and then some sort of a hybrid. The needs are the stuff that you either, you're clothing yourself, you're feeding yourself. They're non-optionals, non-negotiables. The wants, these are your consumer durables, all the things that your industrial metals are going into, they're optional. You don't have to have them to survive. In fact, people have survived without iPhones in past generations, and it seems hard to believe. But
hard to believe, right?
I know. So then you get to the precious metals where, to one degree, it's not a need, it's a want. But the need, or that sense of need, comes into play when people begin to distrust their money, when people begin to distrust the volatility in the markets. And that's largely what we have today, is people buying precious metals for those kinds of reasons, where you look at negative real rates of return. That's been classically the driver of traffic into metals. If you don't have a positive rate of return out there, if your risk is not justified, don't take it.
Okay, but explain that to me a little bit, because we saw QE2, the second round of quantitative easing, I guess drove gold prices almost to 2,000, 1,900 and change. But then gold collapsed down to 1,500. We saw back recently the ECB enormously expand its balance sheet to a size greater than the Federal Reserve now. It's actually the largest central bank in the world, and gold hasn't really budged very much on that. So we keep hearing about, people are worried about the so-called money printing by the central banks, but there hasn't really been that much of a reaction by gold, at least recently, in response to those money printing measures. What do you say to that?
Well, where the appetite has continued pretty steadily is in Asia and the Indian subcontinent. So when we saw this cyclical bear market in metals here in the last 3 or 4 months, say October to the present, that's not been the story if you're pricing it in rupees or in euros or what have you. If you look at those charts, it's actually fairly stable. So there is no price collapse in other currency terms. If you're looking at 2011 returns, even in US dollar terms, we finished the year about 11%, and even higher in other currency terms. Interestingly enough, it is that international audience which has been more important. 1980, we peaked here in the West and in Europe in terms of the primary consumer of physical metals at about 68%. Now we represent 27% of the market, with close to 60% being Asia and the Indian subcontinent. So the power has shifted in terms of the demand dynamics in the metal. They're the ones calling the shots, not us. We're along for the ride.
All right, so bottom line for investors, long term on commodities, definitely a percentage of your portfolio, something you should be allocating money to?
Absolutely. I mean, I think demographics argue for it. The only problem I would have with the industrials is I think you could see a severe snap in China specifically. I think that you do have a period of pass, if you will, in Europe. They haven't solved anything. They haven't changed anything structurally, so that's just now lingering. They were able to effectively kick the can down the road. We feel that that's an area of real pressure on the downside. But where there's upside potential, I think and I think staying power for the next 2 to 3 years would be the physical precious metals, gold and silver. All
right, great. David, thank you very much. That's it for today, folks. I hope you enjoyed it. Stay tuned. There'll be more coming back to you next time. This is Mike Norman. See you. Bye-bye.